5 stocks under $10. That's what we're going to talk about today. My name's Jeff Beers. This is 40 Finance. Today we're talking about 5 stocks that trade under the $10 per share price. First up on our list is Caesars Entertainment Corporation. I chose this one specifically because I follow the online gambling legislation that's been leaking out throughout the United States. I think it's a boon for not only the state governments, but certain corporations as well. Caesars falls directly in those crosshairs. And you see right now it trades at $7.58. It has a debt to equity ratio of 1.16. Most people are looking in the, right around 1 is sort of a benchmark of a good stock, but depending on how much you're growing, it may go up from there and still be tolerable. I like to use it just as a cursory glance until I dig further into the finances of a company. So 1.16, I would say on the first glance, that's not too bad of a start. So I'd be looking to dig into more details about Caesars. Book value per share at 4.52. So this is a little bit high. This is another number where you want it to be closer to 1, the better. The more it's over 1, the more that people are paying a premium for the stock price. So at 4.52, that's a little bit of a red flag, but again, these are just numbers, right? These are just numbers that come off quarterly reports. They're sometimes just flat out erroneous. Other times they are affected by certain one-time purchases, tax adjustments, etc. So I just included it on here as just a general. If you're searching for these stocks, you have these couple numbers handy because they're numbers that I look at all the time. You see here that Caesars overall PE ratio right now though is 2.5, so very, very low. And it has a 1-year target. This is Yahoo's score, supposedly takes into consideration targets from different analysts across the internet. I wouldn't call it scientific. I wouldn't call it necessarily reliable, but it's another good number just to get a feel for where people are landing. They've got it at 12.34, but Caesars, like a lot of companies of late, have taken a hit with the recent stock market pullbacks. So at $7.58, I would say this is a stock worth investigating. I know for a fact that they're going all in on the online sports gambling. So they have partnerships with teams and leagues, and they're growing those partnerships rapidly. So they're sort of coming out of the gate ahead of time and making deals with different teams and leagues, knowing that online gambling for sports is likely just a matter of time, probably in the next 2 years. I mean, we've already got New Jersey, I think Pennsylvania, they're very close, but it's just a matter of time. I think by this time next year, you'll probably get up to the 10 to 20 states. And 3 years from now, you're going to be in 30s and 40s of states. So states need a lot of money. Caesars is trying to put themselves in the midst of online sports gambling. So my recommendation is to look more into this company. And I know for myself, at this price of $7.58, I'll probably take my chance on 100 shares or something like that, put it on the back burner, and see where it goes. Okay, our second stock under $10 is Travelzoo. Travelzoo stuck out to me mostly because I recognize the name from the early 2000s internet era when it was a travel search engine. It looks like they are still alive and well. It looks like though they have shifted their focus more towards the European market. So they seem to be doing better in Europe from the headlines that I was reading. They have offers and packages and offerings that appear to be resonating well with European audiences. So that's probably why I, by myself, have not heard a lot about Travelzoo in the States very much, past 5 years or 10 years even. Looking at the high level metrics, they got a debt ratio of 1.3. This again, if your target is 1, to kind of set the bar for expectations, 1.3 is not that bad. And book value per share at 1.23 is also well within the comfort zone of 1. So at first glance, using these numbers, which is all we're trying to do here, Travelzoo might be something worth investing in, particularly if you're me and you're looking at Internet of Things, online commerce, e-commerce. Those are all spaces that I play in. This might be something I'd be interested in. And P/E ratio of 29.2 seems a little high on first glance compared to some of the other offerings, but the price point is certainly low, and a forward 1-year target estimate of 10. If I could get a feel for what the forward PE is looking like and how much growth they assume in this European market or possibly more international expansion, it might be worth something. I can tell you that Booking Holdings, Expedia, some of the other bigger players in the United States anyway, are not afraid to buy out companies, and they've done it massively. They've bought tons of independent travel sites throughout the last 5 to 7 years. Travelzoo could be in that mix, depending on what Travelzoo's choices are and whether or not they're even looking to sell. So that would require more investigation. But on first glance, Travelzoo, not a bad stock for under $10. Okay, the next stock on our list is Alpha and Omega Semiconductor Limited, AOSL. This company is based in Thailand, and it obviously makes semiconductors. I did not get a feel specifically for which sector they play in, if it was healthcare, mobile, PC, whatever. But what I can tell you is there might be something there. You see a PE ratio of 20. They got a debt ratio of 1.67. And the book value, though, is the one red flag. Very high at 11.79. Again, the closer to 1, the better. So there's an outlier there, and it could mean a lot of things. It could just mean that that they've invested into infrastructure or operations, and right now that cost is high, but they, are assuming the cost will go down over time. Maybe there's contracts in the works, etc. So further investigation required. Yahoo does have their target estimate at $16. So right off the bat, there could be some profit opportunities here if you wanted to do a swing trade. I can tell you that semiconductors are wildly volatile, and you seemingly need one small bit of news from Apple or Samsung to push the whole sector up. And if you like playing with fire that way, then maybe you stash some of this stock in your portfolio for a rainy day, knowing that at some point, Apple, Samsung, any of these big mobile players, they only need to come out with some good news, and this will certainly go up right along with it. So one to watch, at least add it to your watch list. But for me, I'm going to need to investigate more on who their clients are. Okay, stock number 4, Town Sports International Holdings, ticker symbol CLUB. So Town Sports owns and operates quite a few different levels of gym and health clubs, mostly in the Northeast. Looking at Town Sports' overall score, you have a debt ratio pretty low, actually, under 1. Our first one under 1 at 0.81, but you have this negative book value per share, which that's a little bit arbitrary when you see those, but I grabbed a quote out of Investopedia, so when you do see these negative scores, if a company is trading for less than its book value, it normally tells investors that either the market believes the asset value is overstated, or the company is earning a very poor return on its assets. So in terms of the club stock, you could assume that they have a wide variety of real estate or leased property that they may not be getting the return on that the street is looking for, or they're crediting their equipment costs at a much higher level asset value than most people believe to be true. Whatever it is, it doesn't mean that this is a garbage stock. It just means that you should look for those things. It highlights for you that perhaps their assets need further examination to figure out really what the true value is. With a PE ratio under 10 and a 1-year target estimate from Yahoo at $11, I think that there's something to this. Health and fitness, obviously growing more every day. The Northeast is, it's a wide swath of the population, but it's certainly not worldwide. Does this company plan to expand? That's probably their next biggest venture. Can they survive in a very competitive niche? A lot of ideas there that we need to cross off the list before investing. With this PE ratio, with the conservative debt ratio, that it might be a well-run company worth looking at over the long haul. Okay, so last stock on the list is ADT. I personally am familiar with ADT from the alarm systems of way back when in the 90s and 2000s. And that's what ADT continues to do. And what made me curious about ADT is with all the alarm.coms and Google and Wire, all these sort of $100 alarm systems that you see online, can ADT still compete? And the answer is that those online solutions are security systems in a box type solutions have definitely hurt this company. However, their enterprise and B2B business remains pretty strong. That makes sense to me because if I owned a business like a restaurant or a bank or a retail store, probably not going to go with the $200 alarm system that's recording to my laptop, right? You need enterprise level solutions, particularly if you go above small business and get into corporate, etc. So ADT probably has some life there. You'd have to learn more about can they compete in those markets, and that would take some research and investigation. From a broad view though, their debt is fairly low, debt ratio below 1 at 0.62, so that's encouraging. The book value per share, same problem that the club stock had, where it could be some overvaluation. It's not a negative, but you see it's relatively high at 578, 5.78. So did they invest in something recently? Are they projecting a contract down the road that required more manufacturing, etc.? Those are the things that we'd have to look at. But it does have a target estimate about $5 above where it currently stands. So if you're into short-term trading, swing trading, or anything maybe less than a year, and you hope for some good news in the security industry, ADT is probably one to look at. It is the only one on this list that offers a dividend. You see there a 1.89% dividend. Now, on a $7 stock, that's not a ton of money, but for those of you who get into these smaller stocks or you have a requirement that a company must have a dividend in order for you to invest, then there is certainly an opportunity here. So ADT, I think, strong brand name from long ago. Dig a little more if you're interested. The overall metrics aren't horrible, but you need to figure out if they can keep their head above water in what is probably a very tight security business. So that's our 5 stocks under $10 for today. Hope you guys enjoyed this. My name's Jeff Beers. This is the 40 Finance channel, and I'll see you on the next video.